Okay, so tax information for caregivers. Before we get going, I do have a disclaimer that I will read out loud. I know you're probably all literate, but I'm going to read it anyway because I have to. The information included in this publication is for general information purposes only and should not be used as a substitute for consultation with professional advisors. The author does not accept any responsibility or liability that might occur directly or indirectly as a consequence of the use or application of or reliance on this material. It is available with the understanding that the publisher is not engaged in rendering legal, accounting, or other professional services and is not representing any other body or organization. Okay, so that's that part done. So this is what we're going to look at. This is what this particular session is. I did do a much longer version, a little bit more in depth, but this one is very brief information on these topics that you see here, and where you can find additional information if you require it. The main purpose of this presentation is to allow you guys to have time to ask questions. So I'll be going through, make your notes. You can put things into the chat, but again, as Hanuman said, just don't like if you do come off mute or whatever, do not give any personal information because we are recording at this time. So first thing we're going to look at is medical expenses. What are medical expenses? So those two documents that are mentioned there at the top, RC 4065 and the tax folio S1F1C1, they are very good resources to determine what is and what is not an eligible medical expense. So they basically, the RC one there is basically a laundry list, goes through A to Z, and excuse me, sorry. It will say whether the item is or is not a medical expense and whether you might need to meet some sort of criteria like have a prescription or something like that, or if it's unconditional. For example, hearing aid batteries. You know, hearing aid batteries have only one purpose. You buy the hearing aid battery for a hearing aid. The hearing aid itself is a medical device. The battery then would be an eligible medical expense. So eligible medical expenses, say that fast 3 times, are non-refundable tax credits and their amounts paid to or for medical and dental services, treatments, certain renovations, certain travel, there are criteria, and appliances. So we're going to go through a few of the major things that people look at. It is claimed, you can claim on your return for yourself, your spouse, and any children under the age of 18. Okay, and you can also claim on a different line, but it's all part of medical expense for persons who are dependent upon you and they're over 18. And we'll look at those particular, the criteria for claiming those lines are in a few minutes. So I've got all that. So select items, travel expenses. So a lot of people think that if I take a cab or something to the doctor, then I can claim the cab fare as a medical expense. Well, unfortunately not. It must be, okay, transportation to where you receive medical services. So if it is the doctor, yes, that's great. But it must be more than 40 kilometers one way. All right. And the equivalent medical services were not available near your home. The medical travel expenses would include ambulance services, regardless of distance, and also the or ambulance service when you're going to or from a public or licensed hospital, as well as those patient transfer services. For example, my father was in a retirement home, well, long-term care, and he had a pacemaker, so he had to go to the hospital every once in a while to just, I guess they read the pacemaker, see how many times it fires or whatever. So we had to get a patient transfer bus thing because he was in a wheelchair, that we couldn't get him into the car, and that sort of thing, that was an eligible medical expense. So mentioned here 40 kilometers one way, and it must be that. And then you will get the transportation only. So if you're driving 40 kilometers, you get mileage or something like that. So if it's more, so between 40 and 80 kilometers, you get transportation only. If it's more than 80 kilometers, you get transportation, accommodation, meals, and parking. So as an example, a friend of mine, He had cancer, and he lived in Perth, but there was no treatment available in his area, so he had to go to Kingston. So he would drive from Perth to Kingston, and that is just over 80 kilometers one way. So he was able to claim the transportation and all that good stuff because he stayed overnight. So he was able to claim all of those expenses as part of his medical expense. So those are travel expenses. Care, treatment, and training. So the training, this is the part where if you're a caregiver for somebody and you take specific training and how to, I don't want to say deal with, that's a bad way to put it, handle, assist the person that you're caring for. This would be an eligible expense because you are taking it for that purpose of caring for some other person. Construction and renovation. I'll talk a little bit more about this later, but basically it's work done due to a severe and prolonged impairment. So if you have stuff done to your house, for example, I have a business, I do taxes and stuff like that. And one of my clients, she had a stair lift put in because she, does not walk well. Okay. So she had the stair lift put in. She lives in a 2-story house. And that was, there's 2 construction renovation expense credits that you can get. One is the home accessibility credit. And then you can also, in some cases, you can get it as a medical expense. So she was able to, I could put the chairlift on as a medical expense because it was a home accessibility credit and a medical expense, because it was something that was done because of this severe and prolonged impairment that she has to, and it was done to make it easier for her to get around her house, kind of thing. The qualifying individual for these expenses is anybody who has a disability tax credit or they are 65 or older. But again, I'll talk a little bit more about these construction renovation thingies in a little bit. So when you're claiming medical expenses, as I said, there's 2. You can claim it for yourself, your spouse, common law partner, or whatever, and dependent children under 18, and you claim that on line 33099. Okay, it is reduced by a number. Okay, so this particular grid is taken from the 2024 tax return. So you can see that you have to have some hefty amount of expenses or low income in order to get a benefit for your medical expenses. So you would put in all your medical expenses, you total them all up, your doctor, your dentist, your prescriptions, your optometrist, whatever else you've got, you total them all up. And then you have to look at what you have on your tax return at line 23600, which is your net income, multiply that by 3%, and then you deduct it from your total medical expenses. Or you take that what they've got there, 2635, the lesser of the 2, and that's what you would deduct from the medical expenses that you've calculated. So depending on your income, you may not get a lot for your medical expenses, unfortunately, but that's just the way the system works, I guess. The allowable expenses for other dependents. Okay, so that's the other line that you claim expenses on. Now, these other dependents, there's a worksheet that you use because it's using their income. It's using expenses that you paid for the other person, this other eligible person, other dependent, and you must have paid for them. Okay, and basically it's the same principle. You're figuring out what the total expenses were, and then there is going to be a deduction of an amount, the 3%, but it's the 3% of their income. So you go through the calculation and then you would put that number on your return. So those are for people who are dependent upon you and you have paid for the medical expenses. Okay. And so dependent on you, other support, it would include, as you can see, common law parents, common law partners, parents, grandparents, brothers, sisters, and all that sort of stuff. So it does include somebody who's living with you. So attendant care is a medical expense, and this is so you cannot pay your spouse or common law partner to be your attendant and claim it as a medical expense. Okay, it must be somebody else over the age of 18, and that person is doing tasks which the eligible person with a disability cannot do for themselves. Okay. Um, so such tasks could include meal preparation, maid and cleaning services, transportation, personal services, getting them ready in the morning, getting ready for bed, things like that. So these are the attendant services that are being provided. Okay. And the eligible person with a disability is basically somebody for whom a disability tax credit could be claimed. Um, and you can claim the attendant expenses, there you go, sorry, as um, a medical expense. But if the person has the disability tax credit certificate, okay, the little letter, and we'll talk about that in a bit, if they have it and you're having attendant expenses, then the claiming the attendant expenses can impact whether you claim the disability tax credit on your tax return. I know it's all very confusing. So, first of all, let's look at the attendant expenses that would be a medical expense if you met all the criteria. Okay, so we're looking at the type of expense. So these are all attendant expenses, money that you pay to somebody to take care of the person with the disability. All right, so we have fees paid for full-time care in a nursing home. Okay, so retirement home versus long-term care. Okay, the long-term care is constant care and attendance to the individual. The retirement home could be assisted living, independent living. There could be memory care wards and stuff like that. But the organization where the person is living, if it's got the three different levels within there, the independent, assistant, and memory care wards, they would tell you what level of care the person is receiving, and you would be able to figure out whether it's considered to be a nursing home, that particular area of the retirement home. Excuse me. So going back to the first one here. So fees paid for full-time care in a nursing home. All right. The individual who's receiving the care must have the disability tax credit certificate. That's Form T2201. It's just a lot shorter to write. Or a note from a medical practitioner stating that they require this care because they're in the home and all that sort of stuff. Now, in this case, you can claim one or the other, either the disability tax credit certificate or the attendant care. Now, the disability tax credit certificate, which we'll talk about in a little bit, it is, I'm just trying to find the amount that it is right now. It's a non-refundable tax credit on your tax return. And at the moment, so for 2024, the credit you could get would be $9,872. So if your attendant care expenses are greater than that, then it would make sense to claim the attendant care and not the disability tax credit. Okay. Doing your taxes and figuring out how to minimize your taxes is all a numbers game. All right. So you would look at, because you can only claim one or the other, you would look at which one gives me the bigger bang for my buck, the attendant care or the disability tax credit. So salaries and wages for one full-time attendant outside of a self-contained domestic establishment. Basically, this is when you're in a retirement home. If you're living in a retirement home and you require attendant care, you have a PSW coming in every once in a while, mornings and evenings to help you get up in the morning and get to bed, whatever. That would be attendant care. If you have a disability tax credit certificate, then you can claim the attendant care. But again, you cannot claim both the disability tax credit and the attendant care as a medical expense. So you would just sort of have to see which one is more, will give you more of a credit. Salaries and wages for attendant care. Okay, so this is somebody that does not live in. Okay, so you were in your home and somebody comes in to care for you. Okay, and you have a disability tax credit certificate. In this case, you can claim the disability amount, that $9,000 odd dollars, and you can claim up to $10,000 of the attendant care expenses. So again, you're looking at how much were the attendant care expenses. If they're like $25,000, and obviously it's, you're better off claiming the full amount of that. But if it's less, then you would claim the disability tax credit and whatever the amount is up to the 10,000 of the attendant care. Full-time attendant care at home. So this is live in. Somebody is living at the same address and they are taking care of you while they're living there. In this case, the certification that you require is the disability tax credit certificate or the note from the doctor. And in this case, you can claim only one or the other again. Group home. So if you're somebody's in a group home, but generally if we're Dementia Society, it's not going to be a group home. But if it was, then it's the disability tax credit. And in this case, you can claim both the attendant care and the disability amount, and there are no limitations. And then care at a training and care school, institution, or other place like a detox center or something like that. You have to have the disability tax credit or a note. Okay. And again, you can claim both if you have them. Excuse me. So that's attendant care. Attendant care is part of medical expenses. So depending on if you're paying for it, you sort of have to see what the situation is of the person receiving it, where they're living, whether they have a disability tax credit certificate or a note from the doctor, to see if they would be eligible to make the claim for the attendant care as a medical expense. Disability tax credit. So this is separate from medical expense. It's a non-refundable tax credit in its own right. And you fill out the form, the T2201. You fill out Part A, or it's like 16 pages long, but there's really only a couple of pages that are pertinent to whatever the disability might be. So you fill out Part A. I call it the tombstone information, name, date, or not, sorry, the name, self-insurance number, address, and all that sort of stuff. And then you have to get the proper person to fill out Part B. So the basic activities of daily life are what the disability tax credit certificate is about. If you cannot do one of them, then you would apply for this certificate. And it's not really a certificate, it's just a letter. But anyway, so the basic activities of daily life are speaking, hearing, walking, eliminating, feeding, dressing, mental functions for everyday life, and receiving care, like if you have to do a dialysis and stuff like that. So life supporting care. So those are the segments of Part B that you would get the doctor to fill out, and then you would submit it to the CRA. They will send you a letter back saying whether you are eligible or not, and the letter will say you're eligible, and they'll give the reason. So if you're blind, you're blind. There you go. You will get it back saying, okay, because you're blind and you're never going to be cited again, kind of thing. The letter will say that it's effective as of a particular date, and it will go on forever. Sometimes there is a limit, a time limit on the certificate when it's received. And should you get one that does have a time limit, then you have to reapply before before it expires, because you must have it in your hand in order to be able to claim it on your tax return. You don't submit it with your tax return, you do it before, so you have it when you do your tax return. If you are denied, then you can appeal the decision. So that's the form itself. As I said, there's like 16 pages or something like that. But the one with regard to individuals who are suffering from dementia, you're probably looking at the mental functions necessary for everyday life, which is a couple of pages at the back end of the form. So you would get the doctor to fill it out, and they would put down how the impairment affects the person's ability to perform those daily functions. And they would, any of these particular ones, they would say when the effects started. Okay, so sometimes it's a process and it takes a while, and the person may be living with dementia for a few years, and then you go and you say, oh, I'm going to get this done now, and you go to the doctor and they say, well, when did it all start? Do you have, proof of the disability at that point? And you say, yes, of course, and all that sort of thing, and they can backdate the application up to 10 years. The reason for that is there's a little box you can tick on the form so that when you send it in, because it is a credit on your tax return, if it's backdated, you tick the little box, and that allows a CRA to go back and amend the return of the person up to the time limit that the doctor said. So let's say you went today to get a disability tax credit certificate for somebody, and the doctor said, okay, well, it'll be effective from actually the year 2020 going forward. So, okay, well, you've 2020. Okay, so that's my 2020 return, 21, 22, 23, and 24. So all those returns have already been filed. You are eligible to make the claim. So if you tick the box, the CRA will adjust all those returns and you get a handsome little refund sent to you. So that is the disability tax credit certificate. And so these resources here, the first two I've already mentioned, medical expense tax credit and the medical expenses, the laundry list of what's a medical expense and what isn't. Disability related information and disability tax credit are also very good sources of information with regard to the disability tax credit itself, how to go about applying for it. You can do it yourself. Doctors sometimes will charge a fee for it. It depends on your relationship with your doctor. So you can do it online, or you can print out the form and you can take it to the doctor, your choice in how you want to do it. If you do it online, I think you have to have a MyCRA account. I could be wrong about that though, but I think you do. Okay. So some other expenses, other credits and deductions that may be available. So I mentioned the home accessibility credit. So this is a non-refundable tax credit in and of itself. It's on its own line. And you can get up to 15% of the $20,000 that you spend on the home renovation. Now, the renovation must meet specific criteria, but basically it is allowing a person to gain access to the home or be mobile or functional within the home. Okay, and it reduces the risk of harm within the home or accessing it. So as I mentioned, my client who had the stair lift put in, it made getting around the home a whole lot easier. So I was able to put in this in the home accessibility tax credit. Now, because a stair lift is also a medical expense, if you have a prescription from your doctor. So I asked her if she could go get one from her doctor, and she said, oh, she's going to charge me for that. Well, you know what? These stair lifts are not cheap. So if that doctor is charging you less than, $10,000, it's really worth it. So she went and got a prescription. Um, and I was able then to put the same expense, kind of like double dipping. I was able to put the same expense in the home accessibility tax credit line and the medical expense line, which is quite legitimate. You can put it in both places, provided you got whatever criteria, so you meet whatever criteria there are to include it as a medical expense. So you can do that. Multi-generational home renovation. So this is one where you must create a secondary unit within the dwelling, okay, inside the house. Not talking about building one of those little carriage homes in the backyard, okay? So this is within the dwelling that you reside in, and it will be occupied by a qualifying individual or a qualifying relation. So the qualifying individual is someone who is 65 years of age or older before the end of the renovation period tax year, or 18 years or older, and they have eligible for the disability tax credit. Okay, so that is, you can do that. That's an 15% of up to $50,000 that you would claim if you were making these renovations in your home. And if you want more information on that, just go into your favorite search engine and type in that multi-generational home renovation credit, and you will probably get a canada.ca link to click on, and that's the best one to go to. Okay, so other credits, medical expense supplement credit. So this is if you're working and you have low income and high expenses. Because of that deduction amount that I mentioned when you're filling out line 33099, the medical expenses line, your non-refundable tax credits, you may not be able to claim all your medical expenses. So the medical expense supplement will pick up the ones that you were disallowed under the non-refundable line under that 33099. If you're using a program to do your taxes, it will probably figure it out automatically for you. But if you're doing it by pen and paper, and I do know people that still do that, then just make a note if you're doing your medical expenses that you didn't get any, and then see if your your income is below a certain level. You may be eligible for the medical expense supplement. Canada Workers Benefit is another low income credit for people. Disability supports deduction. So this is if you have an impairment in physical mental functions and you paid expenses that no one has claimed as a medical expense, you may be able to get an additional deduction. The GST benefit, that's based on your income, and amounts for eligible dependent is a non-refundable tax credit. So these are other credit, and we'll talk about that one a little bit. So these are other credits. And then there's an Ontario Seniors Care at Home, provides up to 25% of claimable medical expenses. So it's an additional credit on top of the medical expense that you can get. Maximum credit would be about $1,500. And it's also reduced. It's what I call income tested. So it's reduced if your family income is over a certain amount of money, and then it's phased out. So basically, if you're making more than $65,000, family income is more than $65,000, you're not going to get any of this credit. If you're under 35, you're going to get the full credit. Between 35 and 65, it'll be gradually reduced down to zero. Canada caregiver amount. So this is not an attendant cost. Okay, the attendant care was a medical expense. The caregiver amount it's just an amount that you calculate. There are no there's no money paid out to anybody or anything like that. Basically, it's basically you're caring for a spouse, common law partner. The government realized that many people are caring for individuals in their home, and they're not being given any support, financial support from the government for this. So this credit is something that was brought in, and used to be called something else. I forget now. Sorry what it was. And depending on who you're claiming for, there are 5 different lines that you can include this, and calculations are a little bit different for each one. Most of them are income tested, and it's based on the income of the person for whom you are caring. So if they have an income and it's over certain amounts, you're not going to get the Canada caregiver amount, but it's worth looking at it anyway. So the first one, so this is part of the basic personal amount that you will calculate on your tax return. Okay. So this one is the Schedule 5, and this little snippet is from Schedule 5, and it just shows you how you calculate out whether the Canada caregiver amount can be claimed. So just to go back a little bit, so the caring part, so you're caring for a spouse who has an impairment, and you're doing stuff for them that they can't do for themselves, kind of like the attendant care criteria, but you're doing it and you're not being paid for it and all that sort of stuff, but you're doing it for them. So on this one, you're claiming for your spouse or common law partner. Okay. And you put in your basic personal amount, and these amounts are from 2024. If you're eligible to claim the Canada caregiver amount for your spouse. So if you are caring for your spouse, if your spouse has a disability tax credit certificate, chances are you would it would be, you would be eligible here. So you would put in the amount, add the two together, you get 18,321, and then you have to deduct their net income. So as you can see, if their net income is over $18,000, you're not going to get anything. Okay. And basically, you would also, if your spouse has a low income and doesn't even have a disability or anything like that, you would still you could still use this to potentially get an increase to your own basic personal credit on your tax return. Eligible dependent, okay, someone over 18 would claim, oh, under a different line, sorry. So this is eligible Canada caregiver amount for your dependent. You again start with your basic personal amount. You add in the amount, the 2616, and then you would deduct their their income to figure out what you would put on your particular tax return. So this is an eligible dependent, and this particular line is used when you do not have a spouse or common law partner, okay, or you were not living with them, you're separated from them. You supported the dependent through the tax year, and you lived with the dependent in the home that you maintained. Okay, if it's just somebody visiting you, it doesn't work. They have to be living with you. And the dependent must also be parent, grandparent, child, grandchild, brother, sister, whatever the case may be. And yeah, so that's, and they have an impairment, a physical or mental impairment. If somebody is making a claim, sorry. So, and only one person can make the claim for this on this particular line. You can't split this one. Okay. So this, again, the previous one, the amount for spouse or common law partner credit, and this one are part of your basic personal amount that you claim on your tax return. And then there are three, they're literally called Canada Caregiver. So this one is, the calculation is for a dependent over the age of 18, includes a spouse. So you notice that the base amount, this time it's not based on their well, it is based on their income in a sense, but it's a lot higher. Okay. The other one was not. I'm going to go back a bit. The other one was based on your personal basic personal amount on non-refundable tax credit. Here it's a number. Okay, it's an income number that CRA or somebody sets each year. It goes up every year. And so in 2024 it was $28,000. Well, 2841. So you would deduct their income. Okay, the person who you are caring for, you would deduct their income, and whatever is left up to a maximum of 8375, you would be eligible to put on your return if you didn't claim anything on those other two lines. If you tried to claim something on the other two lines and it became out zero at the end because their income was too high, it was over the $18,000, and so be it, and you got zero on those lines, but then you got the 8375 here. If you claimed something on line 303, 3300 or 3400, you would deduct that amount. So let's say you claimed, you ended up getting $1,000 as the basic personal credit added to your own, then you would have to deduct it here. So they don't want you double dipping, basically. And then there is, this one is claiming for each dependent if the person meets all the following criteria. Okay, they're 18 years of age or older. They're dependent upon you. It's a parent, grandparent, brother, sister. It's all the same sort of thing. Have an impairment, be dependent on you, and be resident in Canada. Okay. So this one, though, there is, you notice that if the previous one, it said, okay, if you've claimed something on 30300 or the other line, you have to take it out. Here, they don't have that, because if you claimed anything on those other two lines, you cannot make this particular claim at all. So it's not an eligible deduction. If you had 0 on those other 2 lines, then you can go to this one and you may be able to get a credit from that. The last one, the Canada Caregiver, is for infirm children under the age of 18. It's a flat amount. So and that number there, the 2616, that changes every year as well. You would just count the kids and multiply by the amount, and that's what you would put on your tax return. So those are the Canada Caregiver credits. I know it's a lot of jumbled up information and it's kind of hard to keep it straight, but basically look at your situation. If you're caring for somebody, who is it you're caring for? Okay, so you've got kids, you've got parents, you've got siblings, whatever. Look at the person, look at their age, and that will help you determine which Canada Caregiver line you would be able to use of the 3 that they're Canada Caregiver, and then of the other 2 where you add to your basic personal credit, you would pick one of those and see if you could get anything in there. But again, it depends on their income. If their income is over $30,000, put it that way, don't even bother because it's just not going to work for you. If the income is between and 0 and the 28, then yes, go look and see. You might be able to get a credit on your tax return because you are caring for that individual. So that's the end of the medical credits and all that stuff and whatnot. So this whole presentation started because um, um, I forget his Dean Anderson or Henderson. He sent me a bunch of questions, said, "Can you put something together?" And some of the questions were about managing finances in retirement. We all know that it's just silly expensive to live in retirement homes and all that sort of stuff, and even long-term care. If you don't get the rate reduction thing, it can become quite expensive. It's up to $3,000. Last year, I believe it was about $3,000 for a private room, $2,000 for a basic room. So looking at the inflows of your cash. So when you're considering your investments, try to keep them low risk because you can't really afford to lose your money. So you want to be able to have that money for you for paying for the care, minimizing taxes, splitting income if possible. The rate reduction that's available, at least in Ontario, for long-term care is based on income. So if there's some way to reduce income, splitting income doesn't really reduce income for the rate reduction calculation, but it could for minimizing your taxes. Balancing withdrawals from TFSA versus RSP, because RSP is going to be taxable on your income, TFSA is not, it doesn't show up. Also, because TFSA withdrawals do not show up on your tax return, it's not going to impact your net income, which is a calculation for a lot of things like GIS, the rate reduction, and all that sort of thing. GST, HST credit, Trillium benefits, all those things. Trust. Another question that was received, is it useful? Is a trust a useful strategy for tax purposes? So it kind of depends on the value of the estate that you're trying to put into a trust, because there's a lot of tax implications. If you just put stuff into a trust, there's going to be a tax implication unless it's a trust established on the death of somebody or it's a qualifying disability trust. However, alter ego or joint spousal common law trusts, you can transfer property into the trust with no tax implication. So these trusts can only be opened up by somebody who is 65 or older. Okay. What it does, it says here, takes the assets from your ownership and the trust now owns it, and it's managed either by a trustee, who can be yourself or somebody else that you appoint, which is useful if things happen to go sideways. Then you've named somebody as a trustee to manage your assets for you. And the trust deed, the document that sets it up, will specify what happens to the assets upon your death. Because when you die, that trust also kind of passes away because you're the beneficiary of the trust. Um, so there's a lot of additional paperwork, one in just setting it up, and there's high taxes. So what people do if they do put money into or property into a trust, any income that the trust earns, because the tax rate on a trust is like the highest rate going in Ontario is 53%. So any income that the trust earns is generally passed through to the beneficiary and taxed at their personal rate, which is generally a lot lower. And you still have to file a tax return for a trust. It is a T3 is the document that it's called, and that must be filed every year. An alternative to the trust is the power of attorney, finances and property. There are two powers of attorney. There's this one and personal care. They are not the same thing. Okay, you can have the same person being the power of attorney, but they are very separate documents and they are not the same thing. They're for different purposes. So for finances and property, general power of attorney versus continuing. General power of attorney is for specific or limited period, specific purpose or limited period, gives somebody the authority to do something. Let's say I own property in Alberta and I didn't want to run back and forth to have to sign documents or do this or do that. I know we've got e-signatures nowadays, but anyway, I'm old school. So I can name somebody in Alberta as my power of attorney for that purpose only, to dispose of the property. So you can do that. The enduring one, um, it is one that will go on forever. And you can generally, a power of attorney takes effect immediately, but you can word it in such a way that it only comes into effect at a certain point in time when you become mentally incapable or something like that. So that's the difference between the two. It also makes it very clear who's going to be responsible for your finances if you have this power of attorney, if you do happen to lose mental capacity or something like that. And sometimes, you do it, you have to sign the power of attorney before, okay? If a person is declared not capable, then the power of attorney, they cannot sign it for a power of attorney. And if that happens, then you end up in the situation where you have to go for a guardianship. Okay, and that's going through the courts. It's a bit of a long, drawn out process. So it's better, if you are inclined, to have the power of attorney done before you need it, kind of thing. Most people get them done. My partner and I, we got them done when we got our wills done. So we had our wills and power of attorney for finance and power of attorney for personal care. We got both of them. So those are power of attorneys. And that's that.